Okay, let's talk about Laureate Education. But, this isn't your typical company analysis. From an investor's point of view, this is really a story about a massive radical transformation. It's about a company that completely tore itself down and rebuilt from scratch, creating a whole new investment case in the process. So here's our game plan for today. First, we're going to dive into that radical transformation and see what Laureate looks like now. Then we'll get into the good stuff, the case for growth, and balance it with the very real risks you need to consider. And finally, we'll wrap up with the bottom line, the numbers that matter most to an investor. All right, let's kick things off with the single most important thing you need to understand. The Laureate of today is a completely different animal than the one that existed just 5 years ago. This wasn't a slow change, it was a full-blown revolution. Seriously, it's like we're talking about two totally different companies that just happen to share the same name. To really get a handle on the opportunity here, you have to appreciate this dramatic shift they made, moving away from a messy, complicated past to a much simpler, financially sound present. And wow, this slide really just lays it all out, doesn't it? The difference is night and day. The old Laureate was this sprawling global empire, juggling operations in almost 30 countries with over 1 million students and a mountain of debt. The new Laureate? It's a laser-focused leader in just 2 countries, Mexico and Peru. And get this, it's sitting on a pile of cash. They basically traded worldwide complexity for regional dominance and a rock-solid balance sheet. So, after selling off pretty much everything from Australia to Brazil, what's actually left? What's the core business an investor is really buying into today? What does this new, leaner company look like? Well, what's left is incredibly focused. I mean, look at this. Their entire revenue stream is pretty much split right down the middle between just 2 countries, Mexico and Peru. So an investment today is a pure play bet on higher education in 2 of Latin America's most important economies. And they aren't just some player in these markets. No, they're the big dogs. Their university brands like UVM and Unitech are household names. What's key here is their focus on degrees that lead directly to careers. Think engineering, business, and health sciences. And that last point is huge. Almost half of their students are the first in their family to ever go to university. That tells you everything you need to know about the powerful, aspirational demand they're tapping into. Okay, so that's the company today. Now for the really exciting part, the bull case. Let's see how this all builds into a pretty compelling growth story. With such a focused operation, where's the future growth going to come from, and why should an investor feel optimistic? Well, the growth story starts with some serious wind at its back. Just look at Mexico's higher education market alone. It's projected to grow at more than 9% every single year for the rest of the decade. As the market leader, Laureate is perfectly positioned to ride that massive wave. But hey, it's not just about a rising tide lifting all boats. The bull case really stands on these 4 solid pillars. You've got favorable demographics with huge young populations hungry for education. You've got that market leadership we talked about, which acts like a competitive moat. You've got the financial firepower from that net cash position. And then the real kicker is their hybrid digital model, which lets them reach more students and boost their profit margins. It all works together. Okay, that all sounds pretty great, right? Almost too great. And as any good investor knows, that's when you have to ask yourself, what's the catch? What could possibly go wrong here? So let's flip the coin and look at the other side. And here's the interesting twist. The very thing that makes them strong, that laser focus, is also their biggest potential weakness. I think you know where I'm going with this. It's concentration risk. They put all their eggs into just 2 baskets. So let's be crystal clear about what this means for you, the investor. A bet on Laureate is a direct bet on the economic and political stability of Mexico and Peru, period. All their revenue comes in pesos and soles, so if those currencies weaken against the US dollar, their profits take a hit. A recession in either country could mean fewer students can afford tuition. And of course, they're always competing against free public universities. This is the price you pay for that strategic focus. All right, so we've looked at the good and the bad. We've seen the growth story, and we've acknowledged the risks. Now, let's get down to brass tacks. Let's talk about the money. What do the financials look like, and what are investors actually getting for taking on that concentrated risk? The single biggest, most tangible outcome of this whole multi-year transformation is their balance sheet. It has been completely rehabbed. They went from being vulnerable and loaded with debt to a position of incredible strength and flexibility. And this number right here, this tells a huge part of that story. A net cash position of nearly $20 million. Think about what that means. Instead of spending their cash to pay off bankers and interest payments, they can now use that money to grow the business and, more importantly, to reward shareholders. That is a massive, massive shift. Now, this is where things get really interesting for an investor. Look at that valuation gap. On key metrics, Laureate is trading way cheaper than its peers. Basically, the market is slapping a big risk discount on this stock because of its focus on Latin America. So the multi-million-dollar question is this: is that discount justified, or is this a market-leading growth company on sale? So what are they doing with all that cash? Well, management's playbook is super straightforward and frankly, very investor-friendly. Step 1, pour money back into the business to keep it growing, building new campuses, improving their online platforms. Step 2, take whatever's left over and give it straight back to shareholders through buybacks and dividends. Simple as that. And listen, they're not just talking the talk here, they are walking the walk. In the first half of 2025 alone, they bought back $71 million of their own stock. That is a powerful signal from management that they believe their stock is undervalued. And it's a direct way of putting cash back in shareholders' pockets. So, at the end of the day, it all boils down to this one crucial question. On one hand, you've got a focused, financially solid market leader that's growing and is extremely friendly to its shareholders. On the other hand, you've got the undeniable risks that come with being all in on just two emerging markets. Deciding if that potential reward is worth the risk, well, that's the essential calculation every potential investor has to make for themselves.